Good afternoon. Welcome to Chicago Future of Finance. I'm Oliver Renick. We're live here with VIX popping. Been talking about that for the last couple of weeks on the show here. It's been stocks firm or up and VIX up. Really, the trend has been actually VIX up for about 3 weeks. So now we see VIX pop. Things normalize, a little reshuffling on the deck of the risk assets is what I would call it. If you go to Bloomberg today, there is a lot about the credit card cap, the 10% cap on credit cards. It's their main headline, casts shadow over Wall Street's profit parade. I'm not sure that 10% cap on credit should be a major threat to the economy, but if it is, then we're probably fairly fragile. But I don't really think that's the case. I think that if you've been watching the show, our guests have been really good about talking about that higher VIX and stocks firm environment. So now you get a little normalization. I also put the risk radar yellow for cryptos last week on the idea that we might rotate from stocks into cryptos. So far, I think a lot of this can just be generally kind of chalked up to a little bit of trend kind of adjustment shift. The fact that we were getting volatility rising while stocks were up. Brent talked to us about that at length yesterday. So now that you get a pullback in some of the leaders like, let's say, XLF, which did just make highs, breaking down through the 50-day moving average, it's notable, but it also just might be sort of weeks in the making here. VIX bottomed out back in late December. So this is the daily chart of VIX. And you can see that it's been climbing. So now you get a little move higher to join in with the kind of trend here. There was a trend, so the trend extends. What I'm also interested in is the fact that bonds have now rallied in price, dropped back down in yield. Bonds sitting really in that 4.2% range, now kind of on the lower end of that, closer to its moving average to 4.1. That's despite retail sales being quite solid today. Retail sales were a pretty good number, and generally the commentary around inflation has been fairly positive in terms of us getting the right information from the data. There wasn't anything terrible in PPI or CPI. I really don't think that those were major stories. But a lot of this, too, has been options flows driven. So let's bring in Brent Kochuba, who is joining us, a founder at SpotGamma. And he is in Costa Rica, but keeping us in the loop. Brent, you know, I think this is pretty much in line with what you told us the last 2 times we talked, which was that, one, you pointed out the correlations between single stocks and the index, which were looking like they were calling for a bit of an index volatility revival. And then you also just talked about, and we talked about the trend higher in VIX despite stocks being strong. So tell me what you see here.
Yes, on the point of correlation, we were talking specifically about the Cboe Core 1M metric, and that broke a level that we watched was 8, and that happened last week. And since then, the S&P is down only about 50 bips, but vol's definitely catching a bid. And now you see that Core 1M metric is up a little bit. And I don't want to speak too much about intraday movements of that index, but the point is the same, that you're starting to see some mean reversion now in vol. It's even a little bit more than mean reversion. Again, S&P short-term vol, 1 month is at a 9, 5 days at like a 6. So there's not a lot of market movement. And you got to give credit to the bulls here as they continue to just deflect increasing rhetoric around Iran and Fed actions and things like that we've talked about. So this Core 1M has signaled a reversion in vol. That is true, but the S&P price action still is pretty well supported at this major risk level we've been flagging, which was 68.90. I think we bounced off of that 3 or 4 times intraday today. So it continues to be this bend not break situation in the equity market, which I just think is notable. The commodity space continues to be the standout. Vol catching bid, like you mentioned. Crypto still doing well. And so, you know, it's hard for a bear to sit here with all the things being thrown at this market, i.e. negative news, I would say, and a bid to vol, but, you know, the equity space is still holding up pretty well.
I would say the news hasn't been super negative. I hear you that if you dig, there's some stuff in there. You know, like I was pointing out, I don't think 10% credit card caps are a giant deal. If they are, then we probably should put them on, you know, if that logic makes any sense. Yeah. But I know obviously things have gotten pretty extended. It's been a long bull market, a long, strong economy, so people have been extending risk and credit quite significantly. But we always want to be notable to any type of credit crunch. But if this is like a self-induced kind of imposition, you know, I don't think it's a big deal for the market. It does seem like generally it's kind of one of those moments where we can almost say maybe it doesn't need a reason, Brent, for, that's kind of where I'm at. It's been a very good run. It's been very solid. VIX has been telling us there's kind of something bubbling up under the surface. Crypto's suddenly reawakened kind of out of nowhere, and the metals are strong. So there's risk being taken in other departments as well, which make me less concerned about what's happening in equities.
Yeah, I think you're right on that. I mean, you could very easily see this as some consolidation, some digestion of some highs, and it's a fairly sleepy market. I think the bid to vol is important because it is not a stock up vol situation. I think that there is some genuine hedging. These signs of VIX specs being quite short is a sign. But also, the FOMC, I caught you and Jared were talking about this a little bit yesterday. The forward guidance and the situation with Powell is adding a little bit of bid to vol. The known unknown with the Iran situation, both increasing tariffs and you see some news percolating about bases being cleared and things like that. Again, I don't really follow that situation, so I don't want to offer advice on that. It's just that there are some risks ahead that suggest that, hey, you don't want to be sitting here short a bunch of puts with some possible catalysts. And so, but again, if you see that vol creeping higher and overall the S&P is holding up pretty well, that's just something to really make note of. And now we'll say on the other side of the coin here, when we tested 6,900 or 7,000, as we talked about yesterday, calls were sold very hard into that. And so I think there is some monetization of that upside. And so you can have this situation where we just consolidate. We don't need to necessarily express a big directional move. And I think as long as we maintain the 6,900 level, you have to just keep playing mean reversion because it would be foolish based on recent price action not to. I mean, every little dip gets bought, as you can see on this screen here. And so I think you just have to continue to default to believing that until things break. Now, as you mentioned before, there's plenty of other sandboxes to go to play in to get some volatility, be it commodity spaces and related names. Healthcare was moving certainly earlier, transportation, defense names. So there are these other sectors that still remain fairly well bid in the absence of really a bullish or bearish catalyst.
Brent, I'm going into your trace function, which is always a fun one to use, especially because my routine basically is I wake up at the market open, I see how we open, I kind of go through my emails for the day, then I do other work, and then I come back to the market with kind of fresh eyes. So I like to take your tape and rewind to see the trace into the morning and the trajectory of the day. It weakened up until around lunch, but then to your point, once we started getting into the below 6,900, we found that support. You can see that support being drawn out right now as I scroll along this. And as we push into the bell here, we're in that range. So this is why people love your work and why I think your work is very important, is because doesn't it help us figure out kind of what types of highways we're driving on? Because if we think about investing in stocks and the way options can put in important barriers, create important kind of vortex pools, it's almost like you're on a road, you're driving, and the volatility landscape can change how many lanes you're driving on, where the median is, if there's tight curves or not. And when you have big, powerful market makers incentivized to kind of keep things within ranges at certain points, I do wonder if this could be one of those periods where until we blast through that big round number 7,000, that we might want to get used to a healthy amount of chop here.
Yeah, I think that's true. And if you look at that map, the purple area of that map is what we call positive gamma, and that infers that the dealer or liquidity provider community should be buying those dips, and the market just hit that area, and we've just found support right at that 6,900 level. So when we're talking about risk-off levels, that's not like a line we draw on a chart and just sort of extrapolate, what we think may happen or how we feel. It's just reading the way that people are positioned. And so in this case, that 6890 number we've held in our dashboard as the risk-off level, and that's literally that low where the market kind of just skidded along that bottom for today. And if you're objectively looking at the market, what you see is red above. What does that mean? That means if the market starts to rally, there could be some dealer buying to that upside, right? It's a negative gamma to the upside. That's what red is telling us. So, if anything right now, this market is reading like pretty well supported, and we're not in this situation where we're about to really sort of fall apart because that support is there. Now that support, it's critical to note, a lot of that is 0 DTE based. So what happens is, the deck gets cleared, and the next day people come in and they sell their puts again, right? And they sell their puts again. The problem with that is if you get an escalation overnight with Iran or a Fed comment or whatever it may be, you can't promise that 0 DT liquidity comes in, right? It's musical chairs. It's there, it's still it's not. So keep an eye on these levels. If the level starts to break and vol spikes, then I think we have a meaningful amount of downside. Call it 2 to 3%. So you can wait for that level to break and then put your trade on. You don't have to make that bet right now, because quite frankly, we could rally 1% just as easily as we drop, right? We're sitting on that decision line as we talk about it right now. Now, in terms of catalysts, OPEX is Friday, then we have VIX expiration the following Wednesday, right? Those are always moments to move, but we need a little, there's some path dependency to that, right? Do we sell to these options expirations, which could provide some fuel for a bounce? Do we rally, in which case I think mean reversion to the other side? The other thing is we can't materially sell off vol, which is going to help markets rally until we pass the events or the catalysts that are creating a bid to vol. FOMC is one of those. This Iran situation, I think, is another one, right? If we feel better about that passing without hopefully geopolitical, an uptick in tension, right? Then we can start to sell vol. But at the moment, I don't think anyone has clear eyes on that, right? You don't want to sell puts if you think bombs are about to go off, is essentially what I'm saying. So that creates the Vanna squeeze to the upside, which is again, just an upside catalyst.
I'll throw my 2 cents there as well. Great analysis on the macro, on the news side. The geopolitical stuff has just been buying opportunity after buying opportunity. So I feel like trying to place something on that is just so risky. I'd rather take Super Bowl bets. 1 out of 8 teams, there's 3 trading below 12.5%. To throw in a little commentary from yesterday's conversation with Pete after the Bears win. But that's kind of where I'm at. That's where my head goes, where I'd rather do that type of a gamble than, because I think speculating on the geopolitics and 1, what's going to happen, 2, what the response is going to be. That's been such a fruitless trade and a losing one in so many respects. But understanding 100%. The volatility landscape and saying, look, we may not be in a great position to rally until some of this stuff clears out a little bit. Or to break through 7,000 meaningfully, that's, I think, a very reasonable bet to be made. So I don't know if you have a thought on kind of how to execute that, Brent, because I've also got your tape up, and I think there's a few securities we should move through here too.
First thing is, just have to maintain leaning long or long stance as long as we're above 6,900. I think that's required.
So that's part 1.
And that's part 1. And we also have earnings come up. Maybe those earnings events will be good, and that's enough of a catalyst for that upside. And with VIX at 17, you could say if nothing happens and FOMC is a non-event, we could easily squish VIX and the vol complex back down a few vol points, and that's plenty of fuel for us to finally break 7,000. So I think in this market without all-time highs, you still just got to lean that way, right? It's foolish to bet on downside until your hand is shown, right? Oliver, if I know you got pocket 2s, then I'm going to go against you, but
be careful, buddy. I'm taking that 53% a lot of the time. Ship me that ace
queen. Until we break 6,900, I'm not going all in until under 6,900, and then I'll start pressing some shorts.
Yeah,
and then,
I like that. I like that. So that kind of speaks to that, I think, highway we're on right now that might be fairly kind of tight. There might be some clear levels here in which the market makers have put up some barriers.
Absolutely, and those barriers are driven by people selling short-dated puts, and they're going to continue with that response because look, if you're a zero DT trader, nothing in Iran is going to happen before 4 p.m. right Eastern. Like you can be confident about that. Whereas you don't want to sell 1 month vol because over the next month you really don't know, right? And you don't want to be sitting there overnight with that risk. So market opens from 9:30 to 4. Nothing probably pops off in Iran as an example. So you can feel comfortable with your time horizon of 8 hours to sell some puts.
Keyword there, probably though. I mean, we did pop into Venezuela on a single night adventure.
Well,
that was a zero DT. That was a zero DT event.
9:30 to 4. It doesn't matter. Maybe that's what people assume Iran would be the same thing. I really don't know. Who knows, man? Who's a geopolitical expert? Not only when something will happen, but what the reaction is tricky. It's one of those things you don't want to be short puts if you think a bomb is going to fly, and let's pray that it doesn't.
Totally.
It means you don't want to be short longer dated options in that situation. Turning to the commodity complex.
Silver, SLV,
almost
3 million options.
Bananas. Look at FCX there, which is one name you rarely see pop up on this list.
Copper.
Obviously, a bunch of mining and copper exposure there. That's just going crazy. So this metal complex is really just catching a bid. And it's such an interesting story. It maintains the bid, but you got the AI trade in there. You got the inflation trade, kind of like need to own assets trade, kind of just generally embedded in there. There's restrictions with the what China may export to us or not, import-export restrictions. So it's almost like, if you start to think about it, every story or catalyst is just favoring this complex. And so the fact that I'm now seeing like an FCX pop up there, in terms of this demand, I think is really very interesting. I know there's some metal rebalancing happening. There's just a note out from Goldman simply saying, like, look, this idea that banks are being bought in is hilarious, hilarious joke, and that gets a lot of attention on FinTwit.
Right.
But
Said
the other
the bank.
catalysts are still there. Yeah. So JP Morgan seems like it's going to survive the great silver squeeze if we had to bet. This seems to be the summation. And what's interesting is a name like FCX showing up with almost 1 million contracts trading is pretty unusual. I mean, 775 is still not quite 1 million, obviously, but
look at
you
the
don't
chart,
see
man.
that name very often show up, right?
Chart's
so
going ballistic. Chamath
really
Palihapitiya put out a statement saying the copper is his main trade this year. Did you see
it
that?
just keeps getting bid, right? And so, do you want to trade equities? If it is going to draw interest away from the commodity complex. There are FCX is a stock, right? But it's based off that commodity complex, and you start to see a lot of these moves will crescendo when they start to move. These commodity stocks will start to move the equity vol space a little bit, and we've seen that in Bitcoin in the past, where MicroStrategy, Coinbase, et cetera, will add a real bullish skew to some options and impact some of the measurements that we watch. And if you start to see stuff like FCX move, right, not just the SLV, et cetera, then I think that's a sign that maybe the commodity complex is really starting to impact the equity space in a very interesting way. So that's something to watch, and that's what I'm really paying attention to. I see like an FCX starting to show up on the top options volume.
I will say, tracking, this is why we do this, it has been so useful in identifying when assets are creating enough momentum, hype. The options flows are almost like a hype meter.
100%.
That adds on. I mean, this is why it's second derivative stuff. This is why it's convexity, because you've got, the general slope, and then you have the slope of the slope. And that slope can pick up speed if everybody's talking about it. And so the fact that we were getting major options activity 2 weeks ago and stuff, even after silver had made the move, a lot of times, like when silver buckled here at first week of January, that looked like it could be a technical moment, right? We had the lower high. If you look at it on a pure technical basis, it was a coin flip, basically. But if you looked at the options flows, which were still getting very bid up, very call-centric, that was telling us that basically you were entering almost memification, and here we are. At new highs.
And it's like, it's a very interesting kind of trifecta and it hadn't really clicked in my mind of, you got the geopolitical risk premium, you got the tariff kind of trade baked in there with, countries guarding their assets, then you got just the raw demand of the chip sector and the AI sector and everything else. And then you got the inflation trade where assets generally are just going up because we keep, throwing more money out there ultimately. And that's kind of, I think, the goal. It's like, let's drive rates down. Let's make liquidity cheaper. Let's make liquidity more available. Look what just happened in housing. And that lifts asset prices up, right? And so it seems to be just this, like, everything points to the metals complex generally. Now, is silver kind of like the rate of change of silver is a little bit too high? I think that's what the options market continues to tell us. But we'll only see brief corrections, and that vol comes in hard and then just gets bid rate back up. So, there is absolutely just this continued bid to the entire complex, which I think strengthens overall the trend. You don't necessarily want to short the trend. Maybe you want to short the vol sporadically, but clearly being short this trend, selling calls is a widowmaker in this type of a space. But shorting vol via like put flies, here and there, I think can absolutely make sense. But that is certainly where the action is certainly if you look relative to S&P vol, which is at a 6.
To that point about the memification, I just pulled it up here. I asked ChatGPT when Chamath said go long copper. It looks like it was late 2025, early 2026, basically as this move is happening. So, it definitely is in, the dialogue in a very real way, the metals. Gold obviously had the longest standing trend over the last couple of years, and then silver came along, and now copper too. And I have to say, just based on the chart alone, copper now clearing $6, the old high from the summer. It looks like a chart, frankly, that could be next in the list if risk appetite holds on for this category.
I can't disagree with you on that, Oliver. And one of the things I'd point out in terms of the memification, we run this report called Flow Patrol. And what Flow Patrol does is it looks at our proprietary positioning. So we see where hedge funds are coming in and buying large positions, right? This isn't a speculation on reading tape. We actually see how positions change on a daily basis, and we have a model that measures this. And the report is completely covered in gold and silver trades. which is very, very unusual. Usually you'll see people buying the semi stocks, or you'll see people taking a shot in Caterpillar or Deere or some other healthcare stock, right? But this is all big ETF trades. So that complex is really generating in assets, and it's generating in size. As it gets more attention, like this is the memification, right? It draws more attention, it draws more trading, it draws more assets in size. And so you start to see all of that stuff sort of manifest in this kind of upside exposure that we're seeing. So the attention and the price action is drawing bigger and bigger volume, and you see that in these trades, which are really dominating our daily scanners.
Okay. I love it. The options flows are pretty good indicators as to when things are getting very popular. And I will say that in the context of a trifecta metals rally, it seems like copper would be that third prong. Gold, then silver, then copper, all going into the data centers too, by the way. So you do have the AI, thing connected to it, which kind of makes it a little bit extra fun. Brent, always great, good stuff. Appreciate you very much, sir. Thanks a lot.
Thanks, Oliver. Take care.
You the man, Brent Kochuba, SpotGamma. I got Mr. Jon Najarian on deck, standing by. John, Dr. J, what's going on, my man?
What's going on, big dog? I was just, it was so busy today, I didn't get a chance to have my lunch.
Hey, man, that definition has blurred the line for me. Like I said, I wake up, I check markets, I blast the emails that I got blast, I try and get a power nap somewhere around lunch, and then by the time I'm down here at Cboe, I'm just trying not to spill my coffee.
Well, I mean, it is a great market for traders, and I'm sure all of the traders that love what you do, Oliver, are focused in on, trades like you and Brent were just talking about. I'm still really big on a lot of these defense names, because
we were talking about that geopolitical trade a bit.
Yeah, well, the volumes have been crazy. I mean, RCAT, this is a guy from Puerto Rico. Well, he's not from there, but he lives down in Puerto Rico with me, Jeff Thompson. And he's got drones that they sell to the military, and they are killing it.
What's his ticker, John?
With RCAT.
Oh, RCAT, yeah.
Yep.
I forgot about that one.
I mean, it's doubled nearly since mid-December. Mid-December. I mean, here we are, one day away from mid-January. So in a month, do you like stocks that go up 100%? I do. Yeah. What about V-Wave? VWAV. We talked about this one. We had a big webinar, last Thursday. And it was one of the stocks on my list back then, Oliver. VWAV.
How deeply liquid are these markets, John? Are these risky trades?
Well, I think they're extremely liquid. These guys are trading extraordinary volume. That's why they popped up on our scans. But, when you're looking at the right side of the screen that Oliver just put up there, folks, that is a huge move in a very short period of time.
Vol just went bananas in the weeklies for Vision Wave, right? VWAV?
Yep, Vision Wave. Looking around, like I said, ONDS. I was on with one of your compatriots on the broadcast field, Liz Clayman, and aerial intelligence connectivity that enhances security for defense and so forth. In other words,
that's Palm Beach, Florida.
Palm Beach, Florida based.
Yeah.
The fact that the Department of War is focused in on these stocks, it'd be kind of stupid to not at least keep them on your watch list, because when Trump, or in this case, the Department of War, says, I really like L3 Harris, and I'm going to give them $1 billion to spin out their rocket motors and so forth into a new stock, I pay attention. And last week it was Trump talking about, I don't like that Blackstone, BlackRock, and all these guys have been buying up individual homes. What happened to Lennar? What happened to D.R. Horton? What happened to all these home mail? Boom, to the upside. Yep. I pay attention. I mean, again, you and Brent were talking about, when you've got a pair of twos, I think you've been dealt a full house if you're in any of these stocks.
That's what I'm saying.
And
Press your 53%. Here's what, John, here's where
press.
yeah, well, because the point that I made to Brent right after that, which was that geopolitics, basically trying to trade geopolitics, is like the most reliable losing trade in my mind, because the market generally goes up. However, that's on the index level, because war hype, it can't take down the stock market and the capitalist, machine that's running unless it actually comes to fruition. But it doesn't have to come to fruition for people to buy the machinery, to buy the drones, to buy the radar. So on the stock specific level, I think some of this can make sense. If you think you want to trade geopolitics, I would say you're probably better off doing it on the stock level than the index level, because everything else is going to overpower it on the index level. That's my view.
Yeah, and you've been around it long enough, Oliver, to know that we see rotation on a daily basis. More or less, if you look a little bit longer term, over a week or a 2-week basis, sometimes as long as a month, you'll see a significant rotation. We've already seen it out of a lot of the high-profile tech names in the Mag 7. Does it mean you shouldn't own those stocks? Of course not. But what it does mean is that there are opportunities created when people are exiting those stocks and getting into the defense stocks, for instance. There are opportunities in, stuff like, any of the high performance computing and things like that, or high bandwidth memory. That's a phrase that you'll be hearing a lot more of, folks. High bandwidth memory. That's what Micron does, MU. Whether it's dynamic random access memory, DRAM, or whether it's NAND or NOR. I mean, any of these are things that make the AI run faster.
Sure.
You need that kind of memory. And these days, I mean, it was just yesterday, Oliver, Huntington, HII Huntington, they talked about the successful testing of their autonomous launch.
Wow. I didn't realize that chart was doing what it's doing. That's amazing.
Yeah. I mean, when you're talking about launch and capture of a vehicle from a ship, I mean, these are exceptional technologies. And you know what's in every single one of them in one way or another?
Yeah,
AMD, Micron, to make the AI work. That's just the way it is. And so you don't just have to think about defense stocks, or what goes into a data center, or this or that. What are those data centers, or what is the Department of War running right now? Well, they're running an awful lot of tech, high tech, like when our growlers went into Venezuela and shut down their radar and so forth. And now all of a sudden the whole country's blind. And you and I think, joked a little bit about it a week ago or so, when we said, who sold them their defense? Timu? I mean, it's that's tongue in cheek.
Because that's what happens when you put your economy, into a shadow of the rest of the world, and don't have open markets and don't have open information. You fall behind by a couple generations, and suddenly your toys don't work very well against America. I mean, I like the idea of kind of building up maybe a sort of a basket of these things to take multiple plays. Like you could there's also ETFs, by the way, but I just feel those two, like, look at ITA. That actually looks pretty good. So I guess, that is one way to do it for those that, maybe don't have the, capacity to take a single shot or two on company names, because then if you hit or miss, you kind of live and die by that. The ETF route through ITA is not a bad looking chart, but you're also just going to have to be patient and sit it out to some extent. You're not going to get the potential kind of convexity, obviously, that you would if you were trading options. I think, John, also the fact that these charts are holding in, whether it's the defense names, if it's the memory names, the Micron chart looks fine too. All that kind of points to me, in addition to metals being up today, as this being maybe just a brief little spurt of volatility rather than some kind of, reordering of the deck entirely.
Yeah. I mean, and, look at how much stuff we had thrown at the market in the last 48 hours, 72 hours. You had Iran. and wonderful protests in Iran with millions of people, hundreds of thousands in various cities, and sadly, 12,000 to 20,000. Those are CBS's numbers, not mine. People being killed by the regime. That's obviously something that when the president of the United States says, we stand with you, we're going to be there. I think a lot of people yesterday then heard that when he was in Detroit at the Economic Club or on the floor of General Motors, whatever it was. When they hear that, they get nervous because, is this going to be the long protracted war that we feared that we were going to get into or whatever? My answer is no. This is prime that you just got to cut the head off of the snake. They don't have support. That country does not have support for that regime. They want to be back to where they were in 79. They want freedom, and they're going to fight for it.
Sure.
So
ultimately,
you've got
everybody does.
That.
Deep down.
Yep, hopefully. Hopefully they get a chance to be self-determinant again. But that was just one bit of news. Then the president says we want to cap rates at 10%. I'm not against that at all. But between you and me, Oliver, maybe it should be 6 points over the Fed funds rate, which would still be around 10 or 11%. I think that's a reasonable number.
That's a fun idea.
Here's where banks get money, folks. From you and me depositing funds into our account and then them lending that same money out to other people at a much higher rate. Now, when they do that with credit cards as well, they are borrowing from the Fed and pushing it out to us at 27% if you're paying, over time. That's too much. They don't need 17 points or 20 points or 22 points to shoulder the burden, if you will. Look at the numbers we've just seen. Bank America, Citigroup, Wells Fargo, JP Morgan.
They
we're
seem
talking
to be doing all right.
20 billion apiece from the interest rate play, not their trading side, from the interest rate play. And again, where are they getting the money? From us. They're getting it from, the Fed. And so is it right that they're able to charge that much? Well, first of all, they have to go to like South Dakota because most states have a prohibition against these kind of usury rates. So I'm a free market capitalist. But when I say that, I'm saying that we shouldn't have
exploitation.
Yeah, you're exploiting people here. And it's not you, it's not me, it's not a lot of the folks that are watching this, but it sure is a hell of a lot of young people and people that can't afford to buy things that they want, and they have to buy them over time. And they pay at that extraordinary rate, 27%. So when Jamie Dimon cries a bunch of crocodile tears over, this could really upend the apple cart.
If that's going to upend the apple cart, then we've got issues. Then they definitely shouldn't be doing it. Because my pushback on all of it, the one thing I will say, is that I am kind of a rabid free market believer in this instance, because I think that the lenders also are motivated to not overextend themselves. And so if you start with that logic, now obviously people make mistakes, though, and that's how you get into trouble. But generally, taking ad infinitum the free market system, I'm okay with whatever rate the parties agree to, because it wouldn't be offered if they didn't think the underlying economy was able to sustain it. But that gets on the borderline of philosophical. I think there's a lot of truth to your point as well. And for most people, they probably shouldn't be swimming in that deep of water, okay? Why even put, that part of the pool in play? But I get it. Tell me about the action on it, John, because I know Hans is going to talk some bank. He's got a few bank. He's been on the GS trade. You guys have been in on the bank trade too. What do you do with it here? Because the Bank of America chart looks like it just broke down pretty hard, but the XLF doesn't look so bad.
Overall, the banks will be fine, like I said, about crying crocodile tears and so forth. I think so too. This isn't the first time Trump or anybody else has said that we should have a cap on rates. And if that means that consumers don't get as much credit, and could that hurt the markets if consumers can't get credit? Quite obviously, it would impact the markets. Would it crack them? I don't really think so. I mean, Do we really need to see, the CFIUS, the banks that are out there, that are the ones that are too big to fail?
Yeah.
Are we really thinking they should all be making $20 billion
Yeah.
or more every quarter on the interest rate spread?
Sure.
I think it's too much. And I think if they were able to do it some way other than borrowing from the Fed and so forth to accomplish it, okay, then they can do it. But otherwise, no, if you're taking money from the Fed, I think it's just wrong that they're making that big a spread on our money, because
Sure.
that is our money. If they make
hey,
it
look
off
at the
their
capital markets,
depositors,
though. They're booming. I mean, look, here's the thing. This is a very fun conversation, because then it opens up this whole thing about the functionality of the capital markets right now. Because right now, generally, I look at the capital markets and I go, it looks pretty darn healthy. So debt is kind of the fuel, the baseline for what made this economy what it is. The invention of debt is what keeps the machine greased. Now, obviously, you can overdo it. And I think there's probably companies that want to go public. There's probably more that can go public. But overall, it seems like the machine's working pretty smooth. But why push it? Especially if we're going to try and, also, on the other hand, kind of have regulations on banks that meet certain criteria. Why then allow them to kind of go and, add more risk, I guess. Nobody wants, a banking-centric problem, obviously. It's, the worst kind.
nope. Right.
It's the worst kind.
And so, again, at 27% interest, whatever the max is in South
Right.
Dakota, and I think it's around
quite a bit. Yeah. By the way, the regional banks look good. The KRE sitting right here on the 50-day moving average. I mean, I'm not too worried about this just yet, John. I think to your point, you kind of buy the dip on this stuff.
Yeah, I don't think you should be worried about it. Like I say, this ain't the first time somebody's proposed this. It probably won't pass. But I'm saying from my standpoint, I would be perfectly happy with like a 6 point over the Fed funds rate.
Yeah, fix it to the Fed. I don't hate that. Yeah, why not?
If it goes up to 10, if Fed funds are 10, and that means they can charge 16%, okay. But to have it where it is right now, and have these banks crying about, well, you're the guys that are taking the risk. It's not a lot of risk really right now, guys. Look at the charge-offs, look at all the rest of it. I think these guys, men and women who are working these banks, have been blessed to have us stand behind them an awful lot, and very frequently, to let them post these multi-billions, and I hope they keep doing it, just not on my back. Not on our backs.
All right, fair enough. Dr. J. Hott, appreciate you. Thanks, John. Fun chat.
Thank you, Oliver.
Great stuff. Mr. Jon Najarian, co-founder at Market Rebellion, putting the rebel into rebellion there. All right, we got a 2-minute innovator buffer break. Then Hans Albrecht's going to go through some of those bank charts with us and more. We'll be right back.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovators' floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
Welcome back to Chicago Future Finance. I'm Oliver Renick. Let's talk some banks as they are jamming the last couple of weeks, but getting hit today kind of hard. Mr. Hans Albrecht joins me, CEO at Gamma Options Solutions. Hans, the banks have been a good trade. I know you've been in the likes of Goldman, maybe others. I was pointing out the regionals, which are holding on pretty strong today, but Bank of America is breaking down pretty bad. Tell me what you're seeing.
Yeah, look, they've had a good run. So there's always that element in trading and investing where you kind of have a big run, and we've sort of priced in a lot of the great news, and ultimately they need to digest things a little bit. But I think it's still a great trade. I think for me, I prefer to be, as I mentioned last time, I prefer to be in the investment banks. I think they're a little bit more exposed to the things that are really exciting, that are less risky, right? I want a little bit less exposure to loans and consumer credit risk and things like that. The investment banks are really exposed to all those great things, the deals, the IPOs, the trading revenue, right? We get volatility, we get trading revenue. So that's where I kind of feel like the comfort zone is, because of course over time we have this job issue, the job situation, and I prefer to just be with the smartest guys in the room who know what to do. In an expansion that is really very structural. So AI is structural. It is not a cyclical thing. And they have the best exposure to.
So Hans, to that point then, I want you to chime in on our conversation. I know you heard some of that with John there. I was kind of making the case that I'm a little bit of like a free market extremist when it comes to lending. Obviously you want to have some guardrails, but more monitoring for volatility more so than hard guardrails. And I feel that if the system is generally functioning well and you have secular support in real productivity like AI, capital markets solid, that you should be able to lend whatever rate you want between two consenting adult parties. What do you think?
Well, that's a good way to put it, and I agree. I mean, look, we have taken a little sort of lean towards less free capital markets in the last little while, and of course we know that President Trump is going to do what is necessary this year, as it's an election year, and so it's a little bit of pandering to the people, and it's about kind of juicing things, right? So a lot of what the administration is about is a lot of gas and very few brakes. And so we see that we're getting a lot of tailwinds. I don't know if he needs that extra tailwind. You already have the big, beautiful bill. You've got the tax benefits. You've got the credits coming back to, the child credit. You've got so much stuff going on that's very kind of, sort of stimulus led for the economy. I don't know if you need this.
I mean, look at the productivity number. Productivity is by definition the natural stimulus, okay? That's like the pollen in the flowers, okay? Like that's as good as it gets, baby. That's the honeybee's, favorite. Really, and that's what's happening. Productivity, you get more out when you put in less. So that's a beautiful thing. And to me, is kind of one of the most important benchmarks for the functioning of an economy. So out of the philosophy class for a second, Hans, what does this mean? Buy calls in XLF, buy calls in KBE, buy calls in GS? What about Bank of America? How deep through the discount pile do you go?
Yeah, I mean, productivity. I think we could see fantastic growth, fantastic GDP growth. Of course, we don't know how that affects jobs necessarily, but it's a bit like, you remember that movie Vacation where he's got the extra gas tank and the son says, well, Dad, why don't they just make one big gas tank? He goes, Russ, it's an extra gas tank, okay? You know, you got that extra gas tank from productivity now, as well as all the probably little gas tanks around from all these other stimulating type things. And you know, off we go here. Where it is, it is, in my view, we've seen a shift. You and I talked about IWM last time. Look at how it has performed lately. IWM up again as MAG gets absolutely smoked. And so I think there's a very, very important theme in there. And I agree with you. I think XLE, I mean, oil is kind of a tricky one, right?
Small caps look good.
Yeah.
I'll give you that. Yeah, they do look good.
The small caps look good. And you know what I love about these kinds of trades, Oliver, is if you look at where options are priced, they're kind of still pricing these things. I'd say the same is for staples, same as for industrials. They're pricing some of these things, even though they've had nice little runs, like they're sort of your dad's staples, right? This is new. So as I said earlier, this new AI build out, which is happening all around the world, this industrial revitalization, is very much a structural thing. It's not cyclical. You hear people talk about this, oh, cyclical. It's not cyclical. You're building a whole bunch of New York cities, another 10,000 New York cities, and it's going to happen. So I think the vol is actually a little bit underpriced. So I see that upside is very, very attractive here.
All right, I'm with you basically when it comes to kind of the infrastructure, the industrial revolution of tech. Joe Weisenthal at Bloomberg did this awesome piece about coding via Claude and what he was able to produce from that, and it brought him a lot of joy. It brought his followers some joy. You know, it was super interesting to see a case study on how just your everyday person, obviously Joe's not your everyday person, he's a very brilliant guy, but without an expertise in something was able to have a Claude code create something really fantastic for you. A lot of the stuff that I've talked about here in my own case for the show and otherwise, a lot of AI support behind that. So I definitely sympathize with that, that it's more than just a cycle. So that kind of brings us to the tech and the other items then. You know, if we believe that, then Hans, is the best way to put our money where our mouth is right now to go over to the chart of MAGs, MAGS, the ticker representing the MAG 7, which have been range bound now for months, and just buy the heck out of this thing?
I don't think so. Not right now, Oliver, because I think what you have to.
If it's not a cyclical thing, if this is the power, if this is what gets us here, Hans, this thing's been consolidating, been price correcting for months.
It is, but I think I think the stories are intact, and these are not bad companies. I mean, I think Meta's making some mistakes there, right? So you sort of look at how 3 or 4 months ago, Oliver, we had incredibly high, we had amazingly high correlation within MAG, right? So think of the stage of AI. Think of how manias work, right? Early on, everybody wins. The tide sort of lifts all boats. Everybody's having a great time. You just put a .com on the end of your name, and boom, your stock triples. So you've got this amazing early stage. Now you're sort of moving into where, okay, the investors are starting to be a little bit more discerning. Meta just wants more compute. They want to spend more money. They want stuff. And look at what Trump's doing. He said, listen, Microsoft's agreed to kind of shoulder the cost of some of the electricity. So again, election year, there is pushback against these massive, massive companies that now are dealing with incredible competition in the chip space. They're dealing with having to maybe shoulder some of the cost of what they've created, which is a lot of disruption. And I think that represents a difficult place to be and is just extra fuel for the rotation into those other things. What are you doing? What doesn't get affected like that? Something like a Quanta. It is about maintaining the electricity grid. It's about building it out. It's about all the things that absolutely have to happen, boots on the ground, and that was related to the copper trade and all these other things. This is real world stuff that is now happening around the world. And I think there are interesting places there for this broadening, as well as every other, little business that presented.
Well argued, Hans. I like it. I think the correlation breakdown within MAGs is a very good point, that the companies have separated. That's telling us it's stock specific. We see it echoed in copper, which I know is an important part of this trade too. So I think it fits. I think it's very well argued. Appreciate it very much. Hans Albrecht.
Can I add one more thing?
Please do,
Oliver,
sir.
can I add one more thing? I think what investors are also dealing with is this agentic AI and this Adobe situation. So you've been watching the software names really, really get taken out to the shed. And I think there's a very, very important message in there. And it's that, and I see people on Twitter, on X, they're tweeting, I can't believe it.
Yeah,
Adobe's
Cloud's
is
getting
cheap.
killed. CLOU.
It's unbelievable. These stocks are cheap. That is not how you look at this, at what is happening in the world. You do not look at how a company is doing now. You look at how a company is going to likely be doing 2 years from now. We don't know exactly.
Fair.
But right now, the market is saying Nano Banana is unbelievable. Agentic AI, as you said, is starting to do crazy stuff. There's one video I watched this morning where this thing works all night long while you sleep. This thing is going round and round. The compute never stops. The gears never stop turning, right? This is changing the world, and that is bad news for software. Now, I am not saying Adobe's in trouble. I am saying that investors have to look at this very differently. PE matters zero. They have fantastic cash flow. Investors are looking at this incredibly. This is the most disruptive environment we have ever seen in the history of markets. And they're saying, you're doing great now, but how are you going to be doing 2 years from now? And so it's becoming a very bifurcated, absolute winners, and we don't know what the hell's going on. And Google, for example, is taking over, right? They're now starting to do all these things that 2,500 different companies do. And I think there's some worries in that tech space, which is pushing people into, okay, what do I know?
You man, thank you, Hans. Hot take, I love it. Appreciate it. Don't go long mags, though I think Alphabet looks like the best chart there. Thank you very much, Hans Albrecht, CEO. Gamma Option Solutions, Mr. Nigam Arora. How you doing, sir? What do you think about all that?
Well, Oliver, good. How are you?
You think fade mags right now? That's Hans' take pretty strong, even though he's pretty big on AI. He says go with all the individual stuff or maybe even rotate into small caps. What say you?
Well, so, we tend to combine optimally short-term trades and very long-term investing. So we have to look from both sides, right? So when we talk about Mag 7, so we've had a problem. Like NVIDIA, we're long from core position from $12.55, a lot of profits. So what we have done is we hedged it now. We got some put options on it, basically, right? Microsoft we're long from $31.
Tell me about those puts in NVIDIA, Nigam. Hold on one sec. Tell me about those puts in NVIDIA. What do you think makes sense? How do you hedge it right now? I mean, obviously everybody's different depending on when you got in, but just give me kind of an idea.
Yeah,
what strikes you're
I think the
about.
way we hedge it is just buy a debit put spread.
Okay.
To just buy a spread, buy a put, whatever you feel like it, 170. Maybe 170, sell 140 or something like that. I think that's what you do.
Buy the 170, sell the 140. Wow, Nigam, do you realize that I have
something
lines?
like that.
Can
and
you see the
I
lines
think
on
that's
my
what
chart?
you do with most of Mag
Nigam,
7s at this point.
Can you see the lines on my chart? That's exactly where I've got lines. I got a red line at 170. I got a yellow line at 140. I swear to God, I'm looking at it right now.
Yeah,
so
you got it.
Those are the strikes. I mean, I think we're looking at the same chart basically because 170 you break in NVIDIA, and I think that it opens up a whole door to move through basically the range from July, which is 140 to 170. So that would make sense then to sell the 140 down there, something a little deeper, because I do think you crack 170, you could have problems.
Exactly. Like Meta, we're long from $49, and if this continues for another day or two, we'll do the same thing. We'll hedge it.
Okay. So you've been in the
those
game
are the
for
kind
a
of
minute.
things we do on all Mag 7s. When we start seeing setups, we'll just hedge them because we don't want to take think about it.
What about for Meta? Nigam, hit me with the strikes. What are you thinking for Meta? Give me that same NVIDIA analysis for Meta.
Meta, I think little under 600 will buy a put, 590 or something like that.
Yep, my eye was going towards there as well.
And then sell a put like 510, 520, somewhere in that range.
Okay.
So I think that's what we'll do with a lot of them. Now, what we also try to do is sometimes take on, talk about short-term trades, right? It's earnings season, companies are making presentations. For example, this company called Car Gurus, CARG. So they were at a conference yesterday, and they said their margins are going to be a little bit lower.
Yeah, they got slammed.
As soon as the news broke, we short sold it, okay? We short sold it in your bar, yesterday's candle, right close to the top where we shorted it. And I think tomorrow we probably will take partial profits and lower the stops, so we're protecting ourselves. So we would look for that kind of opportunities. You were talking about banks earlier.
Yeah.
I think banks we want to buy if we get hit more. Not very. This is noise. To me, what's happening is noise. But if they get another hit, 10, 15%, I think we'll buy them.
Okay.
Meanwhile, we're not hedging banks like we're hedging Max 7, and we get huge profits. Think about it. J.P. Morgan, we're long from $34, right? It's $300 some dollars. Bank of America,
Well,
long
like I
from
said,
$7.
you've been in the game. You've been in the
long
game
from
for a
$30.
minute. These are positions that you've had for a while.
Yeah. And
So
what we do is
you're not worried about hedging the banks, Nigam? You think this is just flash in the pan?
Yeah, no, we're not going to do anything. We're going to leave our long-term positions alone.
Okay.
And we have something what we call the trade-around positions, right? So core positions, we're going to leave it alone. The trade-around positions are ours, maybe a week or two or a month, something like that, max. These banks start getting hit somewhere, and we start seeing, heavy volume. We start seeing exhaustion somewhere. I think I'll start buying. We'll call it a trade-around position. We'll leave core positions intact. We'll probably keep stops pretty tight. That's how I think we go.
Okay. So you're more attentive to potential downside in some of the tech names, it sounds like, than you are the banks.
Yeah.
I do feel like that resonates with the trade as well.
Right.
The trend looks a little clearer in financials, actually. Higher highs, higher lows.
Right. And I agree with you, your prior guest here. Some of the charts aren't looking good.
Yeah.
And then, of course, the other thing we're facing right now is all these metals and miners. Again, we got long-term positions, huge profits. And, think about it. Silver,
what do you do with silver here,
$15.
Nigam? What do you do with silver here after this big move?
Well, we took partial profits meaning about 10% of the quantity we've held, a couple of days ago. If this continues, we'll take profits again, small quantity. Remember, our average is $13, right?
I don't know. That's your account.
Yeah, we got huge gains.
Okay.
The problem is, if you start looking at hedging, I'm looking at how do I hedge silver, and you're a better option expert than I am. I just start looking at the implied volatility and what I'm going to have to pay to hedge it.
Cooking, right? You got to do a spread in that case.
Right. Even with spreads, I mean, I was running a couple of models yesterday, and I say, this just doesn't make sense. So what we do is, higher it goes, more we'll trim, right? Our long-term positions. And that's what we do. Now,
so then what if it does pull back? If they have options, because this is a really important point, I think, that's helpful to anybody who's been in this trade that's up right now, because when the options do get so expensive and the volatility is so out of character for the asset, it does become very difficult to hedge it. So do you have to then lean on the technicals at that point, Nigam, if it's about just taking profit?
Yeah.
But what about, when it starts to break? What is your kind of trigger for this chart if you're looking at the futures or SLV or whatever?
So if it starts to break, then I think what we'll do is, it's kind of thing, maybe you're supposed to do it, not supposed to do it. If you have two accounts, you can do it on one account. So we'll have very long-term positions in one account, and in another account, I'll start shorting silver. I probably wouldn't use it because when I look at the
how will you
premium
do if you don't use options?
I cringe.
Yeah, no, they're pretty cringeworthy. But I think that's the challenge then, is how do you hedge the position then if you don't want to use options? Is it just being quick on the trigger? If it breaks a certain level, you start taking money off?
And exactly. I mean, so for example, like our 100% position, we just took some profits of the day. We'll probably take some profits. We're probably left with 50 or 60% of the core position somewhere. And then in a different account, we'll start short selling it. And that's what we'll do. Now, if options become cheaper and I can find a way to have some kind of spread and it makes sense, then, options are always better if you can do it.
Right, but sometimes they get a little out of whack,
Yeah.
But I think that's a good message. Spreads on the big tech names like Nvidia. Don't touch your bank trade. Let it ride, basically. And silver, just be quick on the trigger, essentially, if it looks like it starts to break. Don't get greedy is the message on silver, right? Don't get greedy.
Exactly.
Yeah, and don't waste money trying to time it to the downside as well by buying a super expensive option with no spread or anything.
Yeah, absolutely. Now, silver, if somewhere, I might want to sell. I might want to sell some options, right? Okay. And I have debit spreads, right? I mean, I have credit spreads, something like that, because the volatility is just so high. But you got to be very careful with silver.
Yeah, absolutely. I mean, it's taken on a whole, different life now as we're looking at the options at the top of the show with Brent, millions of contracts traded up there at like the stock index level.
Right.
Yeah.
So we have some algos that have been very, very successful going on now 18 years. Where we're trying to figure out, is this a short squeeze and when the short squeeze is about to end, right?
Okay.
So we're saying silver is a short squeeze right now. I don't see any signs of it ending right now. But if we start seeing short squeeze ending, I'll go ahead and maybe start, selling some call options, right?
Message received.
And buy some call options a little bit higher price.
We got to jump. Good stuff. Like the message. Tech, metals, and some bank trade. Nigam Arora, founder of the Arora Report. Appreciate you, sir, very much. Have a great night. And thank you for tuning in. I'm Oliver Renick. I'm back here 2 p.m. Central Time tomorrow. Thanks for tuning in. Have a great night.